dollar continues to move toward a record weekly decline for the first time in 2024, we suggest summarizing this trading week and, more importantly, assess the potential impact of future macroeconomic events. Recently, we have already pointed out that the recovery of the US dollar in 2024 was more significant than US bond yields, and the greenback has hit the ceiling. Analysts say it's not yet time to sell the US currency, pointing to a weaker US dollar in the second quarter. This week, Fed speakers gave mixed signals, but still kept market hopes alive for a rate cut this summer. On Thursday, Christopher Waller said that the Fed should hold off on a rate cut for at least a couple of months to see if January's hot inflation report was a bump in the road. Throughout the week, in addition to the outlook for interest rates and numerous statements from central bank policymakers, investors have been assessing economic activity. Data indicated that Europe was recovering, albeit without Germany, and manufacturing activity in the United States was strong, which is not the case for the private sector. As a result, the overall macroeconomic backdrop led to the US dollar index stabilizing below 104 and the prospect of recording its first weekly decline since the end of December. Inflation data from the United States, Europe and Japan will be crucial for markets at the end of the week. In our video review, we will reveal what events await us in the first 3 trading days. You are watching the Traders Calendar. Sales. The indicator amounted to 664,000 in December, and the indicator may show growth again in January, according to market expectations. Analysts believe that in 2024 the positive trend is likely to take root, as the market, although revising expectations for Fed funds rates, tends to believe in the beginning of the reduction in June, which will directly affect mortgage rates. If the data meets or exceeds the market's expectations, the US dollar index may strengthen above 104 again. Otherwise, the pressure on the US currency will likely increase and the asset may continue to consolidate. Japanese inflation data will open Tuesday's macroeconomic calendar. The yen is having a tough time. The Japanese currency has weakened, moving above 150 per US dollar and hovering near its 3-month low. This week's economic data showed that the Japanese economy fell into a technical recession in the fourth quarter. In addition, manufacturing activity contracted by the most in 3.5 years in February, and growth in the services sector slowed. Notably, the yen is the worst performing G10 currency this year. Meanwhile, Japan's core consumer price index rose 2.3% in December 2023, slowing from a 2.5% increase in November. The data showed further signs of easing inflationary pressures in Japan, taking pressure off the central bank to raise interest rates soon. And the market is expected to get more evidence of a cooling inflation on Tuesday. Analysts forecast a 1.8% increase in the core consumer price index. Expectations that consumer prices fell again in January could give the Bank of Japan another reason to move away from negative interest rates this year. The regulator is facing a recession and sluggish consumer spending, but keeping its hard-to-lose policy unchanged would mean more pain for the yen. However, if inflation proves to be stubborn, the yen could get a strong boost against the US dollar. On a Tuesday, investors will assess a batch of data that reflects consumer sentiment in the United States. Reports on durable goods orders will be the first to be released. Data for December showed that new orders for manufactured durable goods in the United States were unchanged. Excluding transportation, new orders rose by 0.6%. Excluding defense, new orders added 0.5%, beating market expectations. With the fresh data, the market expects another decline in the core indicator by an impressive 4.5%. If the data is in line with the forecast or lower, it will put more pressure on the US dollar. However, the impact of these reports may be short-lived, as the more important consumer confidence report for February will be released later on Tuesday. US consumer confidence increased to a two-year high in January, and the index soared to 114.8, the highest level since December 2021. The rise in consumer confidence in January reflected slowing inflation, anticipation of upcoming lower interest rates, and favorable employment conditions as the companies continue to add more jobs. However, statistics released as early as February could negatively impact the index. At least that's what the market expects. The forecast is a 4.5% drop in the consumer confidence index to 114 points. If the index shows growth again, the US dollar could be supported. Otherwise, it will remain under pressure. On a Wednesday, Australia will publish its data on inflation. Notably, the consumer price index rose by 3.4% year-on-year in December, down from 4.3% in November. The figure was below market forecast. It was the third consecutive month of decelerating annual inflation due to a slowdown in prices of food, electricity, gas, and other household fuels. The market anticipates a further acceleration in inflation to 3.6% in January, further away from the Reserve Bank of Australia's target range. And the Aussie soared above 0.6555 this week, hitting a three-week high. The minutes of the Reserve Bank of Australia's meeting showed that policymakers discussed the possibility of another rate hike, but decided to keep monetary policy on a hold. Meanwhile, data showed that Australian wages surged by 4.2% year-on-year in the fourth quarter, the highest level since the first quarter of 2009. The overall picture supports the Reserve Bank of Australia's hawkish stance. If inflation growth is in line with the forecast, the Aussie may strengthen against its US counterpart. Later in the day, market attention will turn to the Reserve Bank of New Zealand's interest rate decision. The central bank governor stated that the inflation challenge was not over, citing broad financial pressures to maintain a restrictive monetary policy. Reserve Bank of New Zealand Governor Adrian Orr, speaking before a parliamentary committee, noted that the current rate of inflation was still too high. The regulator ruled out interest rate cuts until 2025 at the earliest, and was one of the first central banks to withdraw pandemic-era monetary stimulus. The country's inflation rate, while below historical highs, is still well above the Reserve Bank of New Zealand's target band of 1 to 3%. In addition, the financial system remains strong and consumers can afford higher interest rates. Nevertheless, markets have reduced the odds of the Reserve Bank of New Zealand rate hike this month and cut the odds of another hike this year to below 50%. Recent data also showed that inflation expectations fell to the lowest level in more than 2 years in the first quarter, suggesting that previous rate hikes have been effective in curbing inflation. The New Zealand dollar is now trading at a 5-week high, and the market does not expect the Reserve Bank of New Zealand to change its stance, as rates are expected to remain at 5.5%. However, the hawkish tone in the regulator's statement could help the New Zealand dollar strengthen. This was a brief overview of the most important economic events from InstaForex analysts. Follow us and make hefty profits from your trades. See you online next week.